Number one would be to read as many property investment books as you can. That will give you, the strategies on different ways you can invest. So read books would be number one. Number two would actually be, speak to someone who's actually physically done it before themselves, because everyone has their own opinion. If you want to get advice and on how, or the right guidance on how you can go from 2 properties as an example to build a portfolio of 5 to 10, then of course it makes sense to physically only speak to someone that has 5 or 10 or 20 properties himself. So whether it's myself or whether it's the mortgage brokers that we've got, you can chat to them absolutely free. Justin or Steve, really good, very experienced as well. Justin has over like 17 properties. Steve's got probably over 8 as well. So just getting guidance from someone who's actually done it before, which to me is very basic and very common sense, but you'll be surprised, not everyone has common sense, unfortunately. How do I make sure all clients are taken care of? Okay, so how I tackle land tax with so many properties is multiple different factors. As an example, right now I've got about 78 going on 80 properties. While anyone would think,
oh my God, there's gonna be a massive land tax bill.
Yes, it is, but it's not as high as you'd think. Every single state has a different land tax threshold. So I personally own properties, as I'm sure you know, in Queensland, New South Wales, and WA, South Australia, etc., etc. Every single state has a different land tax bill. So some states I'm well and truly over the land tax threshold, other states I'm not. Point 2 would be, out of the 78 odd properties that I've got in my portfolio right now, not all of them are houses. I probably have about 35 houses that are houses on land, but then I've probably also got another 30 or 40 properties that are townhouses and units. A unit or a townhouse will have a lot lower land content, as you could guess, compared to a house. I own 1-bedroom unit in Surfers Paradise that I bought, 5-6 years ago. It's only about a 50 square meter unit. The land's only valued at like 80,000, 90,000. So you're not paying land tax on the value of the property. You're only paying land tax on the land, not the property. The valuation between the market value of the land and the valuation between the council valuation is 2 separate things. When council value a land in many different states, it's often not what the market valuation is. It's often usually a very conservative amount based off other factors. Actually, any land tax that you pay, it's actually tax deductible at tax time. So when you do your tax return, and you pay, let's say, 10 grand a year in land tax, or 20 grand, or whatever it is, or 2 grand, that's actually tax deductible the next financial year. So you actually get some of that money back anyway. Those are the main points. Hope that helps.